listener production.
Hi, Helen Smith here with you. Welcome to The Briefing. The predictions around interest rates, AI, crypto and gold are coming in thick and fast this new year. But how can you tell what actually matters and what's just noise? And when global tensions flare, like what we've seen with the US and Venezuela, how do these impact the economy?
I don't want to look at a geopolitical event and just talk about the greedy finance angle. But the reality is if oil does end up being cheaper, it is probably good for the world economy just because that fundamental ingredient oil will be cheaper if more does come onto the market.
That deep dive unpacking the economic trends you need to know this year is coming up in the second half of the episode. First though, let's get into the headlines with Chris Spyrou. It's Tuesday, the 6th of January.
Hey Helen, we're starting in New York this morning where ousted Venezuelan leader Nicolás Maduro and his wife Celia Flores have pled not guilty to the charges brought against them by the US. The pair were captured by US forces in the Venezuelan capital over the weekend, with the charges including drug terrorism conspiracy, cocaine importation conspiracy, and possession of machine guns and destructive devices.
Now, while cameras were not allowed in the courtroom, reporters say they were transported from their Brooklyn jail under army guard and arrived wearing prison outfits. Maduro's feet were shackled, and after entering his not guilty plea, he said, "I am innocent, I am not guilty, I am a decent man." He also maintained that he is still the president of Venezuela and claims he is a prisoner of war. As to his wife, after entering her plea, she said she was not guilty, completely innocent.
Yeah, and it's expected the pair will also contest the legality of their arrest and argue that Maduro is immune from prosecution as he is a sovereign head of state, so hence the language around him being the president there. And that's a title that the US does not recognise when it comes to him because they do believe that he stole the last presidential election. They will next face court on the 17th of March, so it is a little bit of time away. Interestingly though, Helen, there were protests that erupted outside the US court there in New York. Some were thanking Donald Trump, saying that, like we mentioned yesterday, this is great, Maduro's gone. Others are calling for the US to get their hands off Venezuela. So again, that real tension point that we did see in Australia, and we're seeing it in the US, and we're also seeing it in Venezuela. And that's something that we unpacked yesterday in the afternoon episode. Tara Cassidy's filling in for Natasha Belling, and we had listeners, senior journalist Claudiana Blanco, talking all about that. We'll pop a link to that in the show notes.
Back home now, alleged Bondi shooter Naveed Akram has been moved to the nation's highest security prison, Goulburn Supermax, about 190 kilometres southwest of Sydney, where he is set to be held in protective custody. The 24-year-old alleged terrorist is facing 59 offences, including multiple murder charges, following the deadly shooting at Bondi Beach on December 14, which targeted Jewish people celebrating Hanukkah by the sea and left 15 dead.
And it comes as politicians are expected to return to Canberra early this year, within the next 2 weeks actually, to pass laws responding to the terror attack, including cracking down on hate preachers who vilify people of other faiths. Officials are still drafting hate speech laws, but in the meantime, the Prime Minister has also promised a national gun buyback scheme and stronger powers for the Home Affairs Minister to cancel or reject visas of foreigners who spread hate or division.
Meantime, pressure is continuing to ramp up on Anthony Albanese to establish a national royal commission into the terror event, with another open letter being released, this time by a group of former Labor MPs, senators and party officials. The letter's calling for the Royal Commission to look into the causes of the Bondi Beach massacre, the broader ecosystem of terror and hate, and the capacity of the agencies to monitor terrorist threats. But the PM has so far resisted those calls and has instead pledged to work with the New South Wales Royal Commission and argued that a national version would take too long, double up with existing work and create division within the community.
A court in Paris has found 10 people guilty of cyberbullying France's First Lady Brigitte Macron for spreading false information online about her gender and sexuality. The defendants, 8 men and 2 women aged 41 to 65, were convicted to sentences ranging from cyberbullying awareness training to 8-month suspended prison sentences.
They were accused of having posted numerous malicious comments with a clear desire to do harm to Brigitte, falsely claiming that President Emmanuel Macron's wife was born a man and linking their 24-year age gap to pedophilia. Brigitte Macron did not attend the 2-day trial back in October, but the First Lady told media she launched legal proceedings to set an example in the fight against harassment.
And this comes as the Macrons have also filed a defamation suit in the US against conservative influencer Candace Owens, who has also voiced conspiracy theories about the First Lady's gender.
I would stake my entire professional career on the fact that Brigitte Macron, the current First Lady of France, was born a man.
Now, we did a 2-part deep dive into all of that, and we'll pop a link to that in the show notes.
And did you know that Australia slipped out of the world's top 10 happiest countries list last year? Well, we did, and there's one industry body that's not having it.
And the other nations might be happy on paper, but we get paid more than New Zealanders for doing exactly the same jobs.
I'm 19 to 35% happier here.
And Sweden has saunas, but we've got Townsville. And Finland might enjoy unlimited parental leave, but can they pop down to the shops in their togs?
There you go.
What a claim to fame. What a claim to fame. So that's a snippet of the latest summer campaign by Meat and Livestock Australia, a 3-minute ad that dropped yesterday and spends most of its time trying to woo over the world's happiness auditors. And the thing that gets us over the line, Helen Smith, the one thing that gets us over the line, lamb.
Nothing makes us happier than being together, and nothing brings us together like lamb.
So we're top 10 happy country?
I have a feeling this year that you will make the cut. Let.
Just eat some lamb.
Just eat some lamb.
Oh, wow. I mean, I disagree.
Okay.
Yeah.
Well, go, but please mount your case, mount your case.
I don't think eating a little bit of lamb is going to make us happy. Now, Chris, you had a look here and they've actually done some research into why it will make us happier.
Yes, so they reckon Aussies who get a bit of lamb on their forks are 0.6 points happier than those who don't. And there are, of course, other things that make us extra happy, according to the research by Meat and Livestock Australia. They think cracking a beer open and an early morning run and a coffee ritual are all things that make Australians very happy and, you know, could really bump us back into that top 10 happiness list.
Look, they might make us feel a bit better, but for our overall health, maybe we shouldn't be eating red meat every single day. We have done deep dives into this previously, but you've also got here, it reminded you of the pork on your fork ad as well.
Yeah, and I at the time as a kid, like it's kind of just a phrase that you throw around all the time. You're like, oh, get some pork on your fork. And these ads in these campaigns are super effective for that point. But I remember like at the time going, who's running these ads? Like, who is it? And it's so interesting now that you see that there are industry bodies behind it, like the pork on your fork ad, that's by Australian Pork. You know, these annual lamb ad campaigns that everyone's seen on telly, you know, or heard on the radio or whatever, that's by Meat and Livestock Australia. It's just so interesting to me that there's, you know, industries behind it. But I mean, kudos to them. It's a really cool ad. It is 3 minutes long. We'll pop a link to it in our broadcast channel on Instagram. Let us know what you think about it and whether it's got you in the mood for a lamb cut. Because let me tell you, I'm craving it this morning.
Yeah, look, can't disagree with you there. It is pretty yummy. But now it's time to get into your deep dive, Chris, on the economic state of 2026. What you need to look out for, and we unpack all of those buzzwords that you'll probably see.
I'm looking for a man in finance.
Alrighty, yesterday we walked you through how to sort out your dating life in 2026, and in this deep dive, we're going to help you make sense of some of the biggest trends and forecasts surrounding the world of finance. And who better to join us than the Chief Investment Officer of the Motley Fool Australia, Scott Phillips. Scott, welcome back to the briefing and Happy New Year. I want to start with a phrase that was kicking around last year, the AI bubble. The floor is yours.
AI bubble is a thing. So AI, artificial intelligence, let's not dumb it down too much. People know what AI is by now. What's happened, though, is any company with AI in its name, related to AI, utilizing AI, talking about AI, has its share price absolutely soaring in 2025. The question now is this a boom or is this a bubble? What's the difference? Bubbles pop, booms tend to go on. And so the question really is, are these things valued properly? Or is there a whole lot of money being thrown at something that won't pay itself back? In the dot-com crash, after the dot-com boom in 2000, we saw the NASDAQ, which is the tech-heavy US stock index, fall 85%. Here's the thing. Almost every single business model from 1999 exists today successfully. Just the fact that it was too early and the valuations got crazy. If there's an AI bubble, that's what will happen. If it's a boom, we'll see it go on. But again, separate the stock valuations from the use and the value of the technology as a consumer, as a business user. They're very, very different things.
Yeah, Now, forgive me because I'm not one who frequently reads the Australian Financial Review, and these key terminology words wig me out. In the event of this AI bubble bursting, how does that impact people like me and people listening? What's the impact there?
That's exactly the right question, right? So the first thing we're going to see if there is a pop is a lot of technology company valuations will fall. Share prices will fall. Company values will drop. That doesn't feel like a big deal until we remember we all have superannuation. So the first one is going to be, by the way, the Magnificent Seven, another term you'll heard thrown around. God, my industry loves jargon, and I hate the hell out of it, frankly. But that's the game we're playing, right? So the Magnificent Seven is a label given to 7 of the biggest, if not the 7 biggest, tech companies in the world, all listed on the US stock market, on the NASDAQ exchange. It's one of those, there's 2 exchanges, New York Stock Exchange and the NASDAQ, just for anyone who wants to know. The NASDAQ is where the tech companies tend to go. Those 7 businesses have been growing phenomenally, yes, as businesses, but also share price-wise. If there is an AI bubble that pops, those valuations will fall. Now, because the biggest companies drop, that tends to have a bit of an effect right across the share market. We had COVID hit, for example, the Woolworths share price fell. And you kind of go, hang on, who's buying fewer baked beans? They were unrelated in terms of the realities of the business, but the stock market goes, I'm freaking out now. Everything's on sale. So if we see those Magnificent Seven companies drop, we will see lower valuations across the entire market. Other companies might get caught up in it. And your stock portfolio, for some, superannuation for all of us, will likely fall as a result. And so that will make you feel poorer. The headlines will be screaming, X billion dollars wiped off the market, all those sort of things. Long term, how does it impact you? Not at all. If you're a long-term investor, and I think you should be, you just got to go, it happens sometimes. Happened during COVID. That wasn't fun, but we recovered. Next crash that happens, whether it's tech or something else, will happen. We'll recover. So the headlines will be scary. People will be telling you if you should do something different or change something or do whatever. The honest answer is, if you're a long-term investor, if you're putting money into super for the next 10, 20, 30, 40, 50 years, doesn't worry you at all, or at least shouldn't.
Now, the reason I ask about the AI bubble is because it really came up for me the first time when I was doing a little bit of digging around the gold boom and the silver boom. Can you explain a little bit what the connection between the two is?
There's not a direct connection between the two, frankly. But what we're seeing is a lot of people looking around at the world as it is and saying, this is kind of scary. I'd like to get off now. And so AI specifically, not directly linked to gold, but crypto, definitely. And those things kind of, again, think about tech as a general idea and the waves of optimism and pessimism, fear and greed that kind of grab these markets. Not a direct link. What we have seen, though, is a couple of things. Firstly, we've seen a resumption of inflation. And it's probably another conversation for another day. But the reality is, while inflation is going higher, gold is traditionally seen as a hedge against inflation. Why? Because there's only so much of it. And if the price of everything goes up, your price of your gold goes up. If the price of your gold goes up, you get richer. It's supposed to protect you against inflation. So that's the first thing. Second thing is there's a whole lot of people who are increasingly worried about the US in particular and the world in general, the amount of debt that's being carried by governments. The US's interest bill is the second or third largest line item on their budget. So think about that. Just the interest alone, that's a risk. If the US can't meet its bills, you'll print a lot of money. If it prints a lot of money, you end up with inflation. Again, you're back to gold and maybe even a resetting of the value of the dollar if you really, really take that to its fullest conclusion. Again, not something we want to go into in a whole lot of detail. Basically, people looking around going, where should I put my money? Where else can I invest? How do I avoid getting caught if those things come to pass? If inflation stays high and or the US goes into massive money printing to pay the interest, that's the sort of risk that people are seeing. We saw gold up 55%, I think it was, in 2025. That's large. There's no fundamental basis for that. There's nothing that changed by that degree other than a rush of demand, a surge of interest, lots of people buying. Again, as I said, there's no so much of it. So we get a lot of buyers, not many sellers. The price tends to go through the roof.
Is it something, specifically when we're talking about gold, is that something that it's just too late to cash in on? Because I am seeing competing streams of thought, different experts saying different things. Where are you at with that?
Gold is massively above the cost of mining. So generally speaking, most commodities, and again, I won't get too detailed here, if you can get more of it out of the ground just by mining it, the price is going to stay roughly at the cost of extraction, right? Because otherwise, if it's $5,000 to buy an ounce of gold, but you can get it out of the ground at $3,000, well, a whole lot of miners are going to go, let's go and mine. So I'm not going to buy it, I'll mine it, sell it to some other muppet for $5,000. So what you tend to find is supply rises when the price goes up and kind of soaks up that excess demand. And so generally speaking, over the long term, the price of those commodities reflect roughly the cost of mining it, plus a little bit more, a little bit of margin for the miner. Where it's massively higher, there's this huge disconnect. And that's where we are right now with gold. It is the profit margins are probably something like 50% from many gold miners, not all, but many gold miners. So there's huge upside if they mine more. And if they do mine more, supply goes up, demand stays the same, price should come down. That's the way economics tends to work. So I suspect the higher it is, the riskier it is to buy and own it. If you're buying now, you're hoping that everybody continues just to decide all of a sudden they want more of it. I don't own any gold personally. If I go out tomorrow and say, I'll grab some, and Chris, you say, I'll grab some, and we add to the demand, then you will soak up the available supply and the price will stay high. So if demand comes off, we should see those prices reset closer to the cost of production. So I don't know where it's going to go. No, absolutely no idea, mate, because, man, the weekend was the weekend, right? I mean, who predicted that? So I think the risks are greater than the potential rewards. Doesn't mean in some version of the future we can't have higher gold prices.
Yeah, well, you've thrown a few more buzzwords at me, demand and supply, and we will talk about housing before we let you go because
yes.
It's something that we have to talk about. Let's talk about the weekend. The US, Venezuela, oil. Now, at the time of recording, the US market hasn't opened for trading, but with everything that did unfold, and I know we don't like predictions, but what are some of the things that we could expect to see and how will that impact us here in Australia?
So the US market is expected to open up if the US futures trading is right. And the market doesn't open until Monday night Australian time. Who knows what happens from there? The reality is that, funnily enough, this has not moved markets meaningfully. We saw the tariff thing where the market dropped the most in 5 years in April of 2025. This time around, it seems like, and this is the world we're in, right? Donald Trump's done a thing. I guess that's what he does, right? We've almost kind of been a bit punch drunk about what's the impact of those things. And so right now, the brazenness, the disregard for international law is stunning to me. The markets seem to be like, well, I guess that's just Trump doing Trump stuff. And that's kind of, ironically, nothing surprises anymore. And if nothing surprises, then you don't get movements. The stock market tends to price things based on expectations, not on the reality, right? So if I expect something and it happens, the price doesn't change. If I expect something else happens, the price tends to change. In this case, I don't think anyone was expecting the US to go into Venezuela, but I also think at this point it's like, well, it doesn't surprise me, or maybe doesn't change asset values. And this is kind of weird, right? Because it's a big deal geopolitically. It seems for asset values, if anything, it might make oil cheaper if there's a lot more Venezuelan oil entering the world markets. That probably is good for economic activity. Not great if you're an oil driller. The oil company share prices may well fall today if there is a likelihood of meaningful increases in oil sooner rather than later. But for the rest of the economy, oil is literally the thing that greases the wheels, pun absolutely intended. When the oil price is high, it tends to retard economic growth. When the oil price is low, it tends to support economic growth because more people can afford the oil that literally does all the transport, all the heating, everything oil is used for around the world, at least for now. Those things there's more of it, that tends to be good for the economy. So I don't want to look at a geopolitical event and just talk about the greedy finance angle, but the reality is if oil does end up being cheaper, it is probably better politically for a whole lot of leaders, but also probably good for the world economy just because that fundamental ingredient oil will be cheaper if more does come onto the market.
Okay, now before we let you go, housing, based on the movements of last year, what do you think we're in for?
What we saw last year was prices resumed their rise, quickened, when interest rates started falling. Now, what does that say? It says that, and here's the basic maths of if you ever talk to a bank manager, got a loan, got a mortgage, thinking about a mortgage, you go to the bank manager and say, I've got this much money, I earn a month, a week, a year, how much can I borrow? The bank manager types the numbers in and goes, this amount of money, this interest rate, here's the amount you can afford to buy, right? When rates go down, the calculator says you can afford to pay more for the house. So that's what we saw over the last 7 or 8 months. When rates went down, prices go up because you've got the same income and you're paying the same monthly repayment. The only question is, what does that mean I can borrow? For people trying to get to the housing market, ironically, higher rates mean the interest bill is higher, but it also means house prices won't go up as quickly because you go to the bank manager and the bank manager says, no, you can't borrow this much anymore. Your income's the same, the repayments are the same, but the interest rate is now higher. You can now borrow less because the interest rate itself is higher. So if that is the case, and I do think we're likely to have higher rates June 26, I'm sorry to say it, not a prediction, but 3.8% inflation, I don't know how we avoid it. So yeah, I suspect that we have flat or higher interest rates. That probably means the pace of house price growth moderates, hopefully. I'd love it to fall. I suspect there's so much demand, not enough incremental supply. They'll probably stabilise or go up just because supply and demand. More people with more money buying the same number of houses, prices must go up. So that's kind of where we still are. But hopefully the rate of increase will moderate meaningfully. I'd love it to be flat or fall. I'm just not that hopeful or that optimistic.
Well, here's to hoping. Scott, thanks again for joining us on The Briefing.
Chris, thanks for having me.
That was the Motley Fool Australia's Chief Investment Officer, Scott Phillips, speaking with me there. And that is it for this episode of The Briefing. If you enjoyed this chat or you learned something new or you understand a financial term a little bit better, why not send it over to a mate and leave us a rate and a review while you're there? I'm Chris Spyrou. I'll catch you next time.